It goes without saying that if you're watching this video, you presumably want to become a billionaire like Warren Buffett. However, believe it or not, if you only have a tiny amount of money in your portfolio, you actually have a significant advantage over Buffett in terms of yielding returns. You have the benefit of not being a billionaire. Having less money in your investment portfolio than Buffett can actually help you earn better returns than the renowned Oracle of Omaha. Although I'll confess, that statement doesn't sound very persuasive at first. In this video, I'll explain why. Buffett's net worth is over $100 billion at the moment, but it wasn't always like that. Buffett spent the 1930s and 1940s far from a thriving global financial center in Omaha, Nebraska. Because he didn't begin with a trust fund to create his investing empire, and because his family was middle class at the time, his investment portfolio at one point had just modest sums of money. Buffett's career's best returns came from when he was in his 20s and 30s, when he was still only managing money for affluent Omahans. This is in stark contrast to the $650 billion empire he is currently overseeing for us investors who do not yet have billions of dollars in our investment portfolios. It's crucial for us to understand how he invested throughout this period. My question is, given that many in the audience today have a lower dollar investment threshold, do these stocks have names? You've frequently stated that you see many fantastic business ideas, but can't buy because they're too little. We stop looking, which is the correct response. As you deal with smaller amounts of capital, we presume that there are a reasonable number of opportunities because it's always been true. I mean, as I looked at things over the years, it became obvious that smaller companies are less followed and that there are more opportunities for inefficiency when dealing with items that can be purchased for $100,000 in a month rather than $100 million. However, this is not because I'm carrying around in my head the names of 25 companies that we could put $100,000 into, and I simply don't look at that universe anymore. People send me annual reports or I receive emails from managers saying, I have this fantastic thing and I look. And I typically know ahead of time, but I would first look at the size. There is simply not enough time to be looking at a variety of smaller prospects if the size isn't right, and there isn't going to be practically any time. I do believe that when working with very little money, there is almost always a significant inefficiency somewhere. When I first started out, I actually went through all of the Moody's manuals and the Standard Force manuals page by page to find things that I had mentioned to some people. It's probably 20,000 pages, but there were a lot of things that stood out that weren't in any brokerage reports or anything of the like. They were just ignored, and while you could learn about them, no one was going to tell you about them. My judgment is that this is still the case today, albeit probably not to the same degree as it was back then. The Delta Duck Club and the Delta Deck Club were created by 100 men, who each contributed $50. However, 2 of the men failed to make their payments. Since there were only 98 shares outstanding, they purchased a plot of property in Louisiana. One day, someone accidentally fired a gun downward rather than upward, and as a result, oil and gas began to flow from the ground. They changed the name to Atlan, which is Delta spelled backwards, to show how sophisticated this gang was. And a few years later, they were purchasing oil for $3 per barrel, collecting royalties from the company of roughly $1 million a year, and the stock was trading at $29,000. I was making $10,000 per share from each share. No, I was turning around approximately $7,000 per share after taxes and $8,000 before taxes. I occasionally use that as an example of an efficient market because someone called and offered me a share of the cash that had about $20,000 to share in the long-lived industry. I don't believe that you can find those things on the market for $20,000 in cash plus $11,000 in royalties, 2.5-cent gas, and $3 oil. Is that an efficient market or not? You won't need to make significant financial commitments because I'll grant you future hunting privileges on all of my duck clubs. Let me give you an example. Berkshire Hathaway, the business that Warren Buffett owns, has a market value of $660 billion right now. What size investment in terms of round figures do you think Buffett needs to make in order to move the needle? Let's just say that in order for an investment to have a significant impact on the company's performance, it must account for 10% of the total value of the business. To put that into perspective, the investment would need to be approximately $65 billion or $70 billion in order to reach the 10% mark. Let's examine several businesses that are currently valued in that vicinity. General Electric, one of the most recognizable firms in the world, is currently valued at about $80 billion. Currently, the valuation of Airbnb is $70 billion. That of FedEx, which delivers packages, is $61 billion. That of Ford, which makes cars, which is $58 billion. And that of the Marriott hotel chain, which is $52 billion. Then each of these companies are enormous. But for Buffett to have a real impact on Berkshire Hathaway, it will take him to purchase one of these titans in an elephant-sized acquisition, as he puts it. Buffett's investable universe shrinks as Berkshire grows larger and larger as a result. This limits the potential companies that Berkshire can invest in any meaningful way. Contrast it with a lone investor who has only a tiny amount of cash. Let me know in the comments if you have any other questions about investing. Let's return to the video. Let's apply the same 10 criteria here and state that an investment is considered meaningful if it represents 10% of the investor's net wealth. The potential investment universe is virtually limitless because there are more prospective investments available. This investor can invest in anything, from the biggest businesses in the world to his local little business. Finding an undervalued investment is considerably more likely for the individual investor. The investment in the Delta Duck Club Buffett mentioned is a prime illustration of this dynamic in action. The Delta Duck Club was founded as a hunting club, but it soon evolved into a company when it was discovered that the property the club's members owned really had oil beneath it that was worth something. Just 98 shares of this firm were issued. Each share was worth trading for $29,000. Each share represented $20,000 in cash and generated $11,000 in after-tax earnings. After deducting the cash payment of $20,000 from the share's $29,000 purchase price, revenue is obtained each year. In essence, you are investing $9,000 for an after-tax profit of $11,000. In the world of finance, this is what is referred to as a total no-brainer. But there is a crucial qualification as to whether this is a wise investment. Depending on the size of the portfolio making the investment, Berkshire's stake today would only account for 0.0004 of the company's market capitalization. Since this investment represents such a minute portion of the value of Berkshire, it would be so meaningless as to not even be worth Buffett's time to make it. It simply would not make a difference. However, if an individual investor's entire investment portfolio totals $30,000, then this investment in the Delta Duck Club would be fantastic for him because it would account for a sizable chunk, or nearly all of his net worth. For our investor, it would effectively move the metaphorical needle with a modest amount of money, which brings us to our second benefit of investing small amounts of money, less competitors. Generally speaking, in the world of equities, as a company's size grows, more investors pay close attention to it. The likelihood of the stock being undervalued decreases with the number of investors who follow it closely. Although there are exceptions to every rule in general, this one holds true. Let's use Apple as an example. Apple is a stock that is closely followed by hundreds, if not tens of thousands, of knowledgeable investors who work at some of the world's most renowned hedge funds and investment banks and attend prestigious institutions. Given Apple's scale, which is why the firm is currently valued at $2.6 trillion, the amount of attention the company receives, and the number of intelligent people who follow it attentively, the likelihood of Apple becoming much discount is unlikely. Compare that to a business that is only worth, say, $100 million. Simply because it is smaller, this stock will naturally attract less investor attention. Compared to a huge corporation like Apple, the stock probably has a tiny fraction of the followers. This dynamic makes smaller businesses more likely to be mispriced in the marketplace. This is the reason why Buffett stated that if he were managing tiny sums of money, he would concentrate on investing in smaller-sized companies because these kinds of businesses offer greater possibilities. The less competition there is while looking for inexpensive stocks, the better. I am aware that the majority of the movies on YouTube discussing Warren Buffett's investment tactics aren't the most useful, meaning that there aren't many concrete suggestions you can use to improve your own investment plan right away. If you like this approach, I hope to be able to provide you with some practical advice in this video that you can start using to build your portfolio. Here are 3 helpful tips on how to invest modest sums of money for my study of Buffett. Buffett's first piece of advice is to look in places where others don't. Don't waste the opportunity you have to invest in items that are simply too little for major institutional investors when you're investing small amounts of money. Instead than attempting to compete with these powerful players, invest in opportunities that are simply too small to have any impact on funds with billions of dollars in assets. One practical example of these is looking for stocks in nations that aren't well liked by institutions. Professional investors typically concentrate on stocks with American roots, but there are many excellent companies in many different nations that may be undervalued in comparison to their American counterparts. Consequently, the second piece of advice is to concentrate on smaller companies. Warren Buffett has previously stated that he would focus on smaller companies since there are more opportunities for savings there if he were in charge of a much smaller sum of money. Peter Lynch and other reputable investors agree with this statement. Lynch first used the term 10 baggers, which refers to investing in a stock that increases by a factor of 10 from the moment the investment was made. He has discussed how much easier it is for a small company to 10 times compared to a large company, and this makes intuitive sense. 10 baggers are every investor's dream. It is considerably simpler for a business to increase its sales from $1 billion to $10 billion than it is for it to accomplish the same from $100 billion to $1 trillion. It becomes more difficult for a corporation to maintain its current rate of growth as it grows larger. The next tip is to search in what is known as an inefficient market. The easiest way to illustrate what I mean is to offer an example of an inefficient market that I personally invest in, where an asset's price does not fairly reflect its true value. So despite the fact that I reside in the greater New York City area, I invest in real estate in a specific huge American city in the Midwest. In this city, I have the option to purchase real estate that needs work but is still considerably cheaper than the cost of comparable properties because I paid to have it refurbished. This is an example of a market that is inefficient. I might purchase a property for $80,000 and then renovate it for $90,000, making my total investment in the property $107,000 according to this example. Nevertheless, in this real-world example, the house is worth $280,000. Therefore, I made a profit of $110,000 on my initial investment. I truly hope you learned something from this video and make sure to check out this other video from the channel. This is only one illustration of what is referred to as an inefficient market, but there are many others. This has been well favored by others. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching! Want to learn more and be more financially literate? Click on the next videos we have in our channel. showing on the screen right now.